Hello Proponomics people, and welcome to the Sunday Supplement Summary from the supplement on the 21st of April 2024. And this week's I called Relativity and Absolutism, which is a tip of the cap to the fact that ultimately we're looking at things year on year still, and we're still using base data from years where things were a bit up in the air or a bit crazy. Inflation is a pretty good example from 12 months ago, because where we were was hugely high, and we've got a big month dropping out of the figures. Next month, April 23 drops out and April 24 goes in, and that will lead to some changes, which is good news in general, but is already expected and not really taking the temperature right now of what's going on in the economy. Anyway, this week there was quite a big week to summarise in macro terms, because we had bond yields walking a little bit further up. They actually tested the 4.25 marker, which is quite damaging really, to be honest. That's about as high as we want to be going, or in my opinion we should be going at the moment. End of the week about 4.15. We had unemployment figures and employment figures, which I'm more interested in. What percentage of the workforce are employed? The answer is 74.5 compared to 76.2 before the pandemic of 16 to 64s. And ultimately that's 1.7% difference. Where has that 1.7% gone? Has it gone into the unemployment list? No, it hasn't. It's gone onto the sickness side of things. So unemployment at 4.2, it's a rise. It's no surprise to anybody who's been listening to what noises have been coming out of recruiters and all the rest of it since the turn of the year. And there's also this issue with trusting the measurement statistics at the moment as well, which we do need to bear in mind. Then we had inflation and CPIH, which the ONS like to lead with. Basically everything missed its consensus target to the upside, even though it was dropping. So what does that mean? We came from 3.4 to 3.2. Good news, but the market's expected 3.1. That's what caused the bond yields to harden, because that little miss to the upside signals to the market rates are going to be higher for longer. We had some strange chat really from Andrew Bailey, who kind of restricted what he said last week to inflation's going to go down next month, so jolly good. Whether he's trying to pull a bit of a trick on the lay people who don't understand that inflation is going to go down next month because of those big numbers dropping out of the figures, but also because the energy price cap has moved down by 15%. It's absolutely nailed on that inflation is going to be lower. But the Bank of England are predicting 2.2% inflation for quarter two of the year, which I still can't see, because we've still got services inflation at 6%. We've still got wage inflation at 6%. And when April's figures on wages drop through, what we're going to see is that those big 9.8% plus increases in those on minimum wage and those pegged to minimum wage are going to have an impact on the upside on pay. So I don't see why no one's talking about this. I don't see why no one's seeing it coming. And I don't see why no one's predicting the impact it's going to have on the bond markets. But there we go. That's why I do what I do. Also, I dove into Mr. Sunak's speech in some level of detail. Obviously roundly criticised for a fairly typical Tory, work shy Britain, people are getting paid too much. But when you look into it, and I looked into the stats that he shared, in 4 years, an increase of 53% in personal independence payment, too much self-certification going on. Of course, the vast majority of cases, I'm sure, are really bad, but ultimately this government, one thing they've been successful in since 2010 is moving the unemployment rate significantly downwards and really changing the incentive to work. And there has been fallout of that, don't get me wrong, but overall, as a population, from a solely economic, utilitarian, uncaring perspective, then that has been an amazing thing for the UK economy. Now, of course, if that's affected you or anybody in your family or anybody that you know, you may well feel differently about that, but this is the problem that the politicians have at the very top level, and also when you're trying to run the country from spreadsheets, which of course Sunak is a technocrat, and Hunt has very much not necessarily cooked the books, but certainly played the game within the rules that he's been set. What he hasn't thought about doing is changing the rules of the game, which is quite strange as he's an entrepreneur. But Rachel Reeves is quite keen, the potentially incoming Labour currently shadow chancellor, to point out she's going to be continuing to play by the same rules, but of course she's saying she's going to do a better job. So inflation not falling as fast as expected. CPIH, the ONS's preferred measure, running hotter. Core CPIH, that's including housing costs, also hotter than core. Core CPIH above 4.5, core still above 4. Last 6 months of core, though, come down to about 1.8, but that's because we had a big drop in prices in January, which is fairly typical. So we have to be careful before we bake that too far in. But it doesn't look too bad for another 6 to 12 months in advance, although I'm fairly convinced we're going to be bumping around the 3% level, or maybe the 2.5% level, but I think we'll be bumping around the 3% level up and down for a couple of years yet, realistically, and I don't think there's a gigantic incentive for the government really to change that. Retail sales figures flat month on month, and a tiny amount up year on year, but no inflation adjustment for that, so that's only nominal figures. And then I got stuck into Hamptons International Spring Market Report, which I'd highly recommend you read, especially if you've got investments down in the south of England, because they did a bit of a deep dive on London and how it's doing in terms of it's the coolest. It's cooling much faster than any other rental market in the country. Rents are still moving forward, but it had an incredible 17% year-on-year rise on new rents in August last year. Of course, it's whether you want to look at the new rents figures, which tends to come from the Hamptons or the HomeLets or whoever of the world, or whether you want to look at the overall rents, which is what the ONS is doing. And the overall rents, what's happening is ultimately during tenancy rents are going up faster than they've ever gone before to desperately try and catch up. And even though we have reviewed rents every year at the very least, obviously you can only put them up once a year from statute law, but I mean we might do several reviews a year to make sure we haven't got people who've been in, say, 21 months without a rise, because we take quite a corporate view towards rent rises, and still in ours we've got some that are miles behind where the market rent is today. So that's where we're finding at the moment, if you're a more traditional landlord who's never put rents up during tenancies and observed that, this is where some of the tenants are getting these terrible shocks where they were paying 500, they're asked to go to 900 or 1,000, and it's not affordable, and it causes a big problem apart from anything else. But the Hamptons report is really interesting, goes into a fair bit about off-market sales as well, things like that. So what's selling off-market primarily? Well, very expensive houses, so £1 million plus, about 33%, £2 million plus over 50%, but this is symptomatic of a tougher market. People don't want that print on the internet for everybody to see. They'd rather try some soft marketing. Couple of months on average is about how long people do that for, and then if it's not selling, then they might put it on the market. Or what's happening is they might go to market, they do a deal, it falls through, then they come off the market and try and get the agents to sell off market. So the fact that the previous one's fallen through is not necessarily going to impact the price. But the speculation is this is because it's a softer market, or it has been a softer market, and Hamptons think this will change as the market strengthens. Although the way rates are going at the moment, which is basically sideways and a little bit upwards, it might take a little bit longer for that market to strengthen. But then a lot of it's about confidence, and that confidence I'm expecting to be relatively shattered when we come up to an election, even though whatever Labour do probably won't be that bad, apart from anything else. But people need certainty that Labour are in, and they'll look at the noises they make. If Angela Rayner's still in post after all this tax stuff, we'll see what happens, and we'll go from there. But that's the Sunday Supplement summary for the 21st of April. Thanks for listening.